The views expressed in this video presentation are my opinions and not necessarily the opinions of guests and others sharing or reposting this video. The content is produced only for educational and statements in this video as a recommendation to buy or sell any financial instrument. Investing comes with risk to loss of principal. Always conduct your own research and seek guidance from a professional investment advisor. I am not a professional investment advisor. I'm Dollar Will. I'm just a brother out here with an opinion, just like you, trying to make it, just like you. But I've been trading a while, so my opinion has some value. And but I say, listen to it, consider it, take notes on all the people you think are trustworthy, and see how what they say turns out, and you'll come, to your own terms about who you need to listen to. It's not everybody. There's a lot of bad information out there. Even on television, even in the major media, and you're not going to know who to listen to until you put them to some kind of test. So start saving articles of who's saying what, who's telling you to do what, and in a couple of months, it'll be very apparent to you who you need to be. What sources you can trust. But over and above all of that, you need to start to learn how these financial systems work, at least in a very basic way, so you can make some decisions on your own. Because with a very basic level of understanding, it becomes real apparent real quickly whose information is suspect. I started on this path decades ago. Let's see, I'm 55. I started on this path when I was closer to like 23 or 24. Okay, so we're talking about 30 years. James Cramer from CNBC. I used to listen to him, and I still listen. I watch his show and listen to some of the stuff he says. I don't necessarily agree. I'll say we're more alike now than we were, because there was a point where I became more of a technical trader, and there was a time where he was absolutely against it. He used to call it, hocus pocus and all kinds of other derogatory phrases. And then he took a beating in the market, and he turned around and started to entertain the technicals. He used to invite chartists on the show to break down the charts, and through the years, he has learned and he's become a pretty good chart reader himself. And every Tuesday, when I do watch the show, it's usually on Tuesdays, because he talks the technicals every Tuesdays. And so now that he's come around and become embrace the technicals more, I watch him more. Why am I even talking about him? I'm talking about him because he wrote some books early in his career, teaching home gamers how to beat the market. And he provided some sobering statistics in his books about the performance of the quote unquote professionals. And they don't perform that. Let's see. A novice like you, a so-called quote unquote novice like you and I, if we study, it's pretty easy for us to beat the professionals. The professionals don't perform any better than a well-studied home trader or novice, like you and I. So I have a great deal of I guess respect and gratitude for him, for James Cramer, for what he wrote in those books, because when I was looking for information, he gave me confidence that if I studied, I can beat them. I can be no worse than the professionals. So I'm saying all that when someone tells you um, they work on Wall Street or used to work on Wall Street, take that with a grain of sand. That doesn't mean a whole lot. It really doesn't. You have to, ask them move the conversation to, their perspective of the markets and what they think you should do, and or what they, what style of investing they have, and just move past the whole status stuff. Make them show you with some good advice that that'll prove itself over time. You know, so I know that makes it harder. There are lots of good folks out here actually on YouTube putting up videos, for free. Some are very good, some are not. It's doesn't help you when you're trying to learn and trying to discern who you should listen to and who you shouldn't. That's why I say you got to take notes and you got to apply yourself. And as you try to learn over time, you'll see. Write down what the people say on television. Come back a week later, a month later, and then you'll notice a pattern start to form. And then you'll have your short list of people whose opinion have done proven to be valid over time. And so as you begin to learn, you can check in with what they think on the common trends in the market, prevailing trends in the market, and then they'll help you learn, all free. Today we're talking about the S&P 500. The S&P 500 is the 500 largest largest stocks in the stock market. They're referred to as large cap or large capitalized. What that basically means is these stocks have attracted the most investable dollars, put it that way. The biggest slice of pie in the stock market, the U.S. stock market, go to these 500 companies. They have attracted more money to them in the form of people buying the shares than all other stocks. So they're the 500 largest in terms of attracting investment dollars. Okay, so they would, on a relative scale, they would be considered the 500 safest. Okay, they are they comprise pretty much everyone's retirement account. We don't have a lot of choices in our retirement accounts at work. I don't care if you work for the government and they call it thrift. Read the description, and you're gonna see, if you see the words large cap in the description of what that fund is, then we're talking about the S&P 500. Okay, so you need to know, I need to pay special attention to the performance of the S&P 500 when you are watching the news, because that, for all practical purposes, is your retirement account. Okay. What we have here is an ETF called the SPY. It is the S&P 500 Spider. Let me see something. I gotta put something up I wanted to look at. I forgot to get this set. You're gonna look at this together with me. I wanted to see the volume of the SPY. I didn't look at it. Of all the things, all my homework, I didn't look at it. Okay, it's not exceptionally large. Not too bad. It's daily. Let's see. Okay, here's the rise since 2009, which this rise right here is, I believe I heard it's the largest bull run in the history of financial markets. So if you made money during this run, congratulations. That nice number you see in your retirement account, that's why it's a nice number, because this was like the largest bull market run in the history of markets. So now pat yourself on the back and get ready to kick yourself in the butt, because now the game is keeping the money that you made. That's it. You made it, so now don't lose it. So when I was young, I went through one of those cycles. I was under 30. I went from $50,000 to $250,000, and I gave it all back because I didn't know what I was doing. Because I was a fundamental style investor, and nothing in that theory told me when to sell. And so I'm a technical trader nowadays, and technical purist at that. We believe that everything there is to know about the worthiness of a stock for you to buy it. It's in the price. When it's dangerous, when it's about to, when there's a threat to the stock price moving the other way, it's in the charts. You just have to become a good enough chart reader to discern it, and it is going to take some effort. We're talking about the most important skill that you can learn in capitalism is how to invest. You know, you really are. On shaky ground if you are living in a capitalistic society and you don't know how to invest. That's foundational to capitalism is capital, and you have to know how it works, have to know how to invest it. Your freedom is directly tied to how well you can, how well you understand capital and how well you know how to invest it. And we have to tackle this bear and learn this so we can pass this to the next generation so that they don't grow up financially. I'll be kind and say financially illiterate. Okay, you know, I'm not blaming us. I'm blaming the system. The system produces this level of financial illiteracy. But once you know that we are broadly Americans. This is not a race thing. This is an American thing, that we're broadly financially illiterate. Then you can't blame the system anymore. After that, you have to step up to the plate and solve the problem. You know. So if we can, us getting where we want to go, whether that's black people or just poor people or whatever, generationally, if you want to save your lineage from this spiral of poverty of one form or another. Right now, we're dealing with debt bondage, with that college tuition debt and other forms of debt. The only way to end that cycle is to produce a generation of young people who are financially literate at a very young age. That are financially literate before 18. Before they get a car, a brand new car, they should know something about the money and the economy that created the car. In fact, teach them financial literacy, teach them how to read charts and how to trade, and work with your kid to have them earn that car. Let them earn it in the markets, okay? Because if they can earn enough in the markets to get that car, then they can earn enough to get a house. Okay, then they can earn enough to manage their retirement. Maybe even earn enough to retire early, and maybe by your grandchild's generation, your grandchild will be the first one with your last name to be born rich. They will be rich at birth, and so maybe that grandchild never even has to be a part of the labor class. That's got to be the goal. But let me stop rambling like my spiral. I will do that. All right. So we got this support line that was running since 2009 of the greatest bull market in the history of markets. Bull run history of markets. Oh, that's nice. So if you didn't, and I could go all the way back to the 1900s and show the last 100 years of the Dow, and if you didn't participate in that run, that's what's wrong. That's what's wrong with I can say, I'm not going to put it all on black people. I would say poor. If you're poor, if those of us that are poor, we are poor because of our estrangement from this activity. Okay, from 2009 all the way back to say since the quote unquote Great Depression. You go to the early 1930s, 1932, 33. You go in that area and you look at the chart. It looks like Superman. Okay, so our relationship to this activity, or our estrangement from it, that's why we are where we are economically. Okay. So we got to fix this. This is a cultural thing. We have to make this important. Culturally, we have to make this important. Okay. All right. So we got the support for that run, and then this leg right here, and you see the price peeking through this red line, breaking this uptrend. And this is a stochastic oscillator at the bottom showing momentum, and this oscillator is also pointing down. Okay, so we don't know if it's going to come all the way down here. It typically will. Okay, but it's going to fall until it doesn't. But right now the momentum is in favor of it falling. Okay, and this black line right here is a line in the sand that was a theoretical top. Let's put it that way. That was identified by technical traders. People tell you, well, you can't, nobody can time the market. Well, we never said we can time it exactly, but it is a outright lie to keep saying that people cannot make a educated projection, about a theoretical top in the market. People have been doing it for over 100 years. Okay, so that's a myth. Okay, the people telling you that they're getting all kinds of information identifying the top and they're trading it, and they tell you that everything is hopeless and random. It's not hopeless or random. You know, there's a science to this, a little bit of art, a little bit of science, and it's been working for over 100 years. People have been predicting these tops for a very long time, but as long as the masses believe, as long as they can keep you believing that you can't predict these tops, you can't to the penny. No, you can't. Or I'm not going to say, I'm just going to say, I don't know. Because I'm not going to be so presumptuous as to think that nobody knows because I don't know. Okay. Let me just say, I don't know, but I can get close. Okay. And in my first video I ever posted on my channel in January of 2018, I identified this general area where we are. Okay. As a theoretical top. When this price broke out here in April of 2013 and then fell back to it here and retested it. So it broke above this line. It broke above this horizontal line. The price broke above this line here. And then it retested. It fell back to it and sprang forward and continued to run. So at the point that the price broke above this prior high that was back here when the market was falling around 2007, okay, when the price made a new high, everyone that's a technical trader, we knew this was a theoretical top. It's not exact. It's just a general area code. Okay, when the price gets in that area, we could have some problems. There are books published in libraries and in your bookstores that said the same thing. This is not anything secret. It's just a field of study that the people in it know this stuff. The people are not in it, don't know it. Okay, if you want to know more about it, join my Patreon site. Okay, $10 a month. All right, we talk about something that's revolutionary. I watch folks, throw $10 and $20 in super chat on other channels. I'm not saying don't do it. Give them their $10 and $20. But if you want to learn some information that's going to change, that could put you on a path to change your life and change the life of your grandchildren, then you'll sign up on my page and throw me $20. I'm $10. I'm just acting for 10 a month. Get you started on some game. Okay, so what we had this week was that 800 point drop was got everybody's attention, got a lot of folks' attention. So the question now, or the cliffhanger we're on right now is the market going to continue going up or not, or what's the deal? What are we going to do? Do I know? No. Okay, not sure. But I can tell you, going down on the hourly chart, it don't look good. Okay, all right. So this, we fell to this bottom here on this was a bottom on the 5th of April, and then we were rising up to this point on the 13th, and then that's when you got the big drop. Okay, but for the bullish folk in the market, I'll throw them this bone. Even with that drop, the low on the 5th held. So that's a sign of strength. So Could we go higher? Maybe. So what you should be looking at home is this high here from the 13th. If the price goes above that high, that would be a sign of encouragement. That at least for now, for this period of time, maybe the price can keep going higher. There is an outside chance that the price could go higher, one more minor leg higher. Okay, I'm talking about a trivial amount, just a trivial amount above this. A few hundred, maybe. I don't want to say 10 or 20%, but just a small amount higher than this high. So we could be talking about a month, something trivial, but in the bigger picture, this correction is going to happen. So in the now, as in this week coming up, we're going to know if it continues going further. And technically, all eyes are on this low here. So first you have this low, this line in the sand, from August the 5th. So all eyes are on this low from August the 5th. And then after that, all eyes would be on this low from June the 4th. Okay. So in this week, now that's just the bigger picture of what's going on with the S&P. Technically, are we in this hell that everyone has been fearing or not? Okay. In terms of where the money went this week, this is a site called stockcharts.com. They have some good free information, and they have some stuff that's worth buying too, as well as bar charts. They have some stuff that's worth buying. I jump around on a lot of charts because all of them offer some information that I can't get on another chart. So, some stuff you pay for, some stuff you get for free. You see this week, in order to stay sharp about where the money is going, every week you should get in the habit of seeing what happened this week, not just whether the market went up or down. You want to know internally the different industries in the market. Where did the money go? Where did the money go? Because what you'll see is money will start to rotate from sectors that made a lot of money during that big bull market run. What we were calling the biggest bull market run in history. That long run. So money will start to rotate to other places. So this week, in the midst of all that stuff, we see the biggest loser was energy, and of course, my name is Dollar Will. I track the U.S. dollar because the dollar is the most important currency, and it has a relationship with energy and metals, an inverse relationship with energy and metals. And so later in the future posts, I'm going to deal with the dollar and break that down, as well as and I'm going to do another one with gold. I don't know if I'm going to get to them today, but definitely before this weekend it's out. And you definitely need to watch both of those. So you've had a lot to watch today. You got the hour video I did earlier about the bond. You need to take that in. You got to get this free game, and you got to see this one here about the S&P. Then later I'm going to do one about the dollar. Then I'm going to do one about gold. Okay, because when you put all that together this weekend, you'll know what's going on in the week ahead. You'll know what you need to pay attention to and what you need to ignore. But when the dollar is gaining strength, that's negative for energy, and the dollar is gaining strength. When you've heard people talk about the currency war in the news, that's money fleeing other currencies around the world coming to the U.S. dollar. Okay. And when the dollar is strong, that's bad for energy and metals. And so this materials is, I would say, energy and metals, and that also would go for things like steel and aluminum, those basic materials you need to build large projects like homes, cars, bridges, things like that. So any kind of construction stuff, a strong dollar makes those materials weaker, and so those stocks will go down. Okay, so energy is going down. Oil is looking very much like it's going to revisit its low that it made during, let's say, following that big run up to $147 a barrel. Then oil ran down to, I think, like $25. And my opinion is it's going to revisit that area, okay, and possibly go lower than that, okay. So, sidebar, that's going to make oil and gold and ocean transportation, ocean shippers, ocean freight liners that involve in transcontinental transportation of these raw materials. When we talk about trade between America and China and getting stuff to Africa, well, it's got to get there on a ship. And those stocks are in the dirt. They're in the toilet, just like the energy stocks. So, in the midst of all of this Bitcoin talk, don't forget about the tried and true things like gold and energy and shipping stocks. Okay, so when the time is right to buy those things, I believe cryptocurrencies are going to be cheap, but it's going to be a hard decision. Do I buy a daggone cryptocurrency, or do I buy a daggone oil company or oil shipper? Okay, so I don't know. I mean, I'll probably end up buying them all. I think they're all going to be good deals, but we're going to have oil companies as penny stocks. Okay, we're going to have oil companies as penny stocks. So that's going to be pretty rough on that real estate sections market in, say, Texas, and those places near the oil concerns in Texas. So the whole name of the game is to survive this downturn, uh, try to make some profit, so that you will end up having a lot of money with a lot of stuff being very cheap. So, that's how you flip the game. So, we turn the tables on this whole 1% controlling 99% of the wealth and all that. This is where it gets corrected. This is where you get your share. This is where the big come up. This is it. This is it. All right. So we got energy at the bottom. We got the financial sector, of course. Companies, if they're growing, which they're not right now, they take out loans and stuff from banks and stuff. So that's good for banks. But when the growth slows down, the banks can't make loans. Nobody's growing, so why would you need a loan for? Banks are really worried about, can you pay back the loan that you already took out? And so that's going to be bad for the bank stocks. Okay, consumer discretionary, that's the biggest items. Of course, there's a house and a car. Discretionary really means things you don't really need. So I'm not going to put a house and say you don't need a house, but you might not have needed that particular house. You definitely don't need all your designer clothes and handbags and all the uber expensive stores in the mall. And that's your mall closing. That's the consumer discretion space. Okay, so you're going to see all these things near the bottom of the list. They're going to stay at the bottom as you get in the habit of every week checking these industries, or you can just come hang out with me every weekend and we'll go through it. You're going to see these stay at the bottom and get hammered, and you're going to see these two at the top stay at the top. This one here, real estate sector fund, it's going to die. It's going to die. So I wouldn't get so too accustomed to seeing this one stuck here at the top. Of course, I'm of the opinion that we're going to have the interest rate rise, and it's going to kill this. It's going to kill this. Technology going to slow down just because the growth cycle in the economy is slower. And with that being the case, companies are not going to upgrade their software and their technology if last year's software is working. Certain critical pieces of software, security stuff, of course, they're going to update that, but other stuff, you're going to limp along. They're going to limp along with those last year's computers. Okay, if it's not broken, they're not going to fix it. They're going to keep it going. Healthcare, certain sections, yes. So, but the definite is consumer staples. Consumer staples is food. So, when markets slow down, people they stay home. That's what we call it, staycations. They stay home. They don't travel anywhere. unless it's by car. They go to a family member's homes. That's a road trip by car, and they stay in the home and they eat. Okay, so and drink. We we smoke, whether that's cigarettes or now weed. That's what people do. And when in economic times like this, I wouldn't even be surprised if we had a baby pop, an increase in the birth rate with people staying at home with no money to go anywhere. It doesn't take a whole lot of creativity to figure out what people are going to end up doing. All that smoking and drinking and staying at home. Okay, you fill in the blank. All right. Utilities. We're back to playing Monopoly as kids. You started out the game, everybody's got the same amount of money, and you spend too much, your cash get low. What do? You start buying those utility companies because people are always landing on those utility companies in that Monopoly game. Well, in real life, people are going to pay that utility bill. And the utility companies, they need energy in order to the raw materials like coal, um, and natural gas and oil. They need energy products in order to generate the electricity. Okay, for you. That would be electrical, natural gas is part of it. So we're talking about the utility. We're making a distinction here between the utility company and the raw materials used to create the utility, to create the power. Okay, so utility companies consume these energy products, and with the dollar getting stronger and the energy products getting cheaper, that allows the utility companies to run their business at a higher profit month over month, meaning every month their profit goes up because the material that they need to create the utility or to create the energy is getting cheaper. So the fundamental style traders, they love that. Every month over month and quarter over quarter, the utility companies are going to be making more profit hand over fist. Not to mention the fact in a few months we have this thing called winter that's guaranteed to come, and the utility companies are going to be selling more power in winter at a cheaper cost to them, because the materials they need to heat everybody's home going to be cheaper. So utility stocks are going to go ridiculous. They're going to go ballistic. Typically they don't rise that much, but this time is different. This time is different. So if you recall on the brain trust, and I think even in a video on my own channel back around Thanksgiving time, there was a downturn in the market that lasted from, I think, November through Christmas Eve. And then this big run we've been on in the stock market followed that decline from November to Christmas Eve. And in that window of November to Christmas Eve, I did a video and I showed that the most profitable space in that downturn was these two. I called it before it happened that it would be these two, and it turned out that it is these two. Why? Because there's a playbook that big money that they use in times when the market is quote unquote correcting, when your Apple and Netflix and your big sexy tech stocks, basically, when they run up too much, there's a playbook of where they go, and it's in this consumer staples and utility sector space. And I called it back in November to Christmas Eve, and as the market started to rise, I said, then whenever this run is over, remember these things that rose when the times were bad, because you're going to see that playbook repeat itself. And sure enough, it's repeating itself, you know? So it took me a while to learn this stuff. I had to read a lot. I had to take a lot of notes, and I had to read books that told me the same thing multiple times that I was too daggone dense to accept it, you know. And then I had to live it, write notes, look back at it, and then just like feel ashamed that it took me that much repetition to learn something so basic. But I got it, okay. And it's going to be the same for a lot of you. It takes a while to unlearn, stuff that was put in your head, you know. So that's what we got going on there. So we have these funds. So who made money? This right here is an ETF called a small cap bear. So as the market was declining, this particular stock goes up. It's an ETF. It's exchange traded fund. An exchange traded fund is a basket of stocks. This one symbol contains many, many stocks all under this one symbol, similar to a mutual fund. The difference between, and a mutual fund is a basket of stocks. The difference between an ETF and a mutual fund, the main difference, let me put it that way, there's a different fee. They both have fees associated with it, but the main difference is you can trade the ETF intraday. So whereas with a mutual fund, you can only trade it at the end of the day. So if you want to buy a mutual fund, you go online and you enter into your brokerage account and say you want to buy that fund. Well, at the close of the market at 4 p.m., you'll get the 4 p.m. price and you own that fund. If you want to sell that fund, you go into your account and say you want to sell it. And whatever that price is at 4 p.m. that day, that you exit the fund at that price. Well, at ETF, if it's at any point in the day you want to get in or out, you can. So when ETFs came along, that put a big dent in mutual funds because why would you want to own something that you can only trade at the end of the day when with ETFs, you can trade in the middle of the day. Something happens in the middle of the day and you decide you just want to get out, and you want to get out now at the price you're looking at on the screen or very near that. An ETF allows you to do it. Well, anyway, this small cap bear ETF is a bet against the market. It's a bet that the market will go down. So when the market goes down, in theory, it's supposed to go up. And generally it does. But I had some bad luck with another one that didn't quite do as it should. The reason, my theory, is from one, as much as I can understand, as much as I've read about it, why these ETFs don't always do what they should, is these ETFs purchase derivatives. Okay, they purchase futures and options. In this case, it would be a put option. Now, and usually what big money, what they do is when they are long the market, let's say they're betting that the market will go up and there's a small downturn coming, what they will do typically is buy one of these bear market funds as a hedge against their account, or they'll go into the in the options market and buy some puts, so that if the price of their S&P 500 goes down, they will make money on the put option they purchased or this bear market fund that they purchased. And the gain in the put option or this bear market fund will offset the losses that they had in the S&P 500. So you go, well, you might ask, well, why wouldn't they just sell if they thought that way? Well, they're getting a dividend payment from that S&P 500. They don't want to necessarily interrupt the dividend payment. So you have to own the stock during a certain holding period qualifying period in order to get that dividend payment. And so maybe you're in a fund or that pays you a dividend payment every 3 months. And a dividend payment is money to the stockholders of let's say holders of a stock or a fund, just for owning it. Just for owning it. Some companies take some of their profits every quarter and they actually give a kickback to the stockholders. for you to put in your checking account or whatever and spend it, or you can buy more shares of stock with it. And so the dividend has nothing to do with the stock price appreciation. That's just free money from the companies. And you have a lot of rich folks, they live off of dividend payments. And as I said earlier in a video about the bonds, some when they loan money to to governments, whether state or federal or corporations, and they make their living off of the interest payment from the governments and corporations via that bond. So what they'll do is they'll buy puts or one of these funds, when their opinion of the overall market is that, okay, the market's going higher, but this pullback is just going to be momentary. This is not going to be a prolonged pullback. This is just a regular pullback, and I want to protect my position, protect my portfolio. And then when the price is falling enough in the S&P, or what I project to be enough, I'll take the hedge off, or they call it insurance. They'll call it, refers to this as insurance. I'll take it off, and then I'll spend the money, or use pour it back in the S&P 500, so that I'll buy more shares at a cheaper price, and then let the fund keep going, and my dividend won't be affected. In fact, the dividend payment will increase because you just bought new shares, which increases your stock basis. So now you make it even more money every quarter. So that's a technique that a lot of people do. And now and so that will work to make this thing rise as people buy those puts. Now, that works as long as the general sentiment is that the market is in a general upward trend. At the point that the general public feels that, okay, this whole market is going down, I'm not going to be long the market anymore. Therefore, I don't need this put insurance. I don't need to buy these options as a hedge against my long position. Now, when the market makes that change, and they no longer are buying put options as insurance against their long position, these ETFs do some strange stuff. They don't necessarily keep rising like they should, okay? But for a period, you'll get one of these. Like what we're looking at here is that run from 2015 to 2016, where the market dropped, and this ETF rose. And then when the market started rising again, of course, this thing went in the dirt. And what you see here at the bottom, and this is a small cap. This is the 2,000 smallest companies in the market. And the small companies are the most vulnerable because they don't have the money to make it through bad economic times. They don't have the money to make certain that they can pay their staff. So these small companies are more likely, or will be the first to lay people off. They are the canary in the coal mine, okay? Their systems are so fragile, like the respiratory system of a canary. When that canary dies and you're in a coal mine, and that's telling you need to get your butt out, because that canary's respiratory system is more fragile than a human's respiratory system. And so that's why the coal miners will take the canary down there with them, because they can't tell that there's not enough oxygen in the air, but that canary's respiratory system will let them know, oh, shit, the canary died, it's time to go. So the canary in the coal mine is the small cap stocks that's letting the bigger companies know that the economy is slowing down, and it's starting to trouble these smaller companies. And the big companies know, well, it's not going to be long before we feel it. Okay, so the small cap stocks fund, or ETF in this case, it hit its all-time low back in August of last year, whereas the S&P 500 just made its let me rephrase that. The small cap stocks hit their high, and this right here, being an inverse of that, made its low in August of last year. So the small caps hit their high in August of last year, where the large caps just hit their high very recently. So the small caps signaled the top in the market almost a year, almost 1 year before the large caps hit their high. Okay, so now we got the part about the small caps being more fragile. They also are more volatile. So in this 2000 right here, it also has some micro caps and penny stocks. Shout out to Matty Ghost. Matty Ghost is the penny stock trader, but he's safe now. He's working them technicals. Matty's vicious with them stocks. This brother is on it. Especially now that he's hanging out with me and learning how to trade technically. All right. So the small caps are more volatile. So we see here in August, this particular fund, as the small caps took a vicious dive, this thing went from a low of 39 to a high of 93. Okay, so that's serious. Now on the way back down, looks like we got a nice little double bottom here. So all you other chart readers, you know that we got a higher low here, and that's indicative of a turnaround, an uptrend. So I'm of the opinion that this fund has reversed, and this bear fund, small cap bear fund, is going to be zooming. The confirmation of a reversal is when it breaks a higher high above this point. Okay, so we'll see what happens. So just as those other times when I showed you that it had a nice rise, like here. Well, this is one of those times. I think this is one of those times. So the question is going to be, how long will people buy put options? How long will the general bullish optimism persist? My opinion is that people will buy these put options as long as people on TV still tell them to buy the dips. As long as they have that buy the dip mentality, I think they're going to continue to buy these put options. And when they buy the put options, that corresponds to this thing rising. So in the short term, this thing is gonna it's gonna make a vicious move. You know. I don't think 1,000% is out of the question. I don't think that's out of the question. So that's one way that people are playing this. But again, I would put this in the category of a Vegas bet. This is hot. This is risky. Learn how to trade. Of course, learn how to read charts. Talk to a financial advisor in concert with. Even if you were to join my Patreon site, I still want you to talk to an advisor. The only thing I'll add about when you get this financial advisor, make sure that they embrace technical analysis. Don't get a financial advisor who only uses fundamental analysis. If they use fundamental analysis, that's fine. Make sure that they also combine it with technical analysis. And so even if you're hanging out with me, talk to your professional advisor. Take the stuff that I say and go ask them about it. And then you make up your own opinion. In the end of the day, you have to make up your mind, So that's one way people are making money. They are buying this small cap bear market ETF. Okay. Here's a NASDAQ 100. You'll see words like this one says bear. So that lets you know obviously what that is. This one here is a mutual fund, and you'll see words like inverse. You'll see words like inverse or bear, whether it's an ETF or mutual fund. But when you see the word inverse or bear, that means that it goes up when this thing goes down. When in this case it's the NASDAQ 100. Okay, it's the largest 100 stocks on the NASDAQ, and that would of course include Apple and all of the tech stuff, AMD, all that kind of stuff is going to be in there. And like I said, this one closes every day. You get the 4 p.m. price at the close of the market, and you can see right here It's flatlining. So it looks like it has found the bottom. Okay. And let me this is quarterly. Let me go to a weekly. Look at it that way. Yeah. So this was the 22nd of July. That's its lowest point. So it looks like it's found the bottom. Let me see. Let me look at it daily. Okay. So you had a nice little downtrend. It broke out above it, and it's settling along. Now, of course, we're not going to really have. It's going to be more encouraging that we really have hit the bottom when we make if we make a higher high. If this thing was to go below this point here, I'd get out of it. I'd run. You know. And like I said on the S&P chart, if we go up for a minor, if the chart runs higher for another minor leg, and it will be minor, if it goes higher above this high here, July 26th, if that happens, the actually this will go lower. The small cap will go lower if that happens, and well, it should. In theory, it should. It very well may. It very well may. Let me not say it will. It very well may. And this particular mutual fund will go lower. I'm sorry. Let me get this straight. If the S&P goes higher by another leg, this small cap bear fund could go lower. Okay, it could. The Nasdaq 100 could this inverse Nasdaq 100 could go lower, but you would have to you would first see the S&P, or in this case it would be the Nasdaq, also going higher. So the bottom line is these are high risk vehicles. You don't get in this unless you're watching it every day and you know what you're doing, you know. So it doesn't take a genius though to say, hey, if it goes below this point here, I'm out. Okay, but you'd have to be willing to say buy it at 24 and risk losing maybe 10%, or that's not 10. That's a little less than 10%. You'd have to be willing to be wrong and risk losing a small amount from here to below here, you know. But this is what you talk to your financial advisor about, assessing that risk, and they will help you determine. They will help to decide if you are the type of person that can assume this level of risk. Okay. So we're not talking hodling. We're talking about picking something for a rational reason, meaning because the S&P, in this case, the Nasdaq, is likely to go down. So we will buy it for that reason. And then, we will pick a point where we'll get out if it goes below that point. But that's something for you to discuss with your financial advisor. That's even if you sign up for my account. I still want you getting advice. Get the other side, get the fundamentals, from that other side, because I'm not licensed, okay? And it's illegal for me to give advice. So this is not advice. I'm in full compliance with the law. This is not financial advice. You have to be licensed to get advice. So I'm not trying to take the money, take you away from the people whose job it is to give advice. Here's another mutual fund. This one is a small cap fund as well, by a different company. Same kind of thing. Same kind of thing. Come on. My computer is freaking out on me. You see them look similar. It's got a nice little bottom in it too. Around the beginning part of this month. And this is a monthly chart, so that's why it looks like that. So you see it's got a nice little base too. Looks like it's good to go. All right. Then we got another one here. Now, we know the biggest economies out there are what? China and the United States. China makes lots of stuff, and America is the biggest purchaser of stuff from China, okay? This symbol shorts China. So this is a global slowdown in the economy. So all that money made by the United States and made by China, you can get some of it. You can get cash in on the pain by shorting, just like that small cap fund. You are shorting small American companies. Well, this symbol here, shorts or bets against China. Okay, so you can get some of that. But again, you gotta start to learn how to read charts, and you want to discuss this with your financial planner. You know, whether you join my site or not. But you see a nice little bottom here, and the lowest low was what, from January of 2018. Okay, so close is 36.68. Closes, hold on, this closes 36.15. Yeah. So and this is a monthly chart. So the lowest point was in January of 2018. So a bet against China back in the month of January 2018 didn't really lose any money. Okay. So this economy, this stock market, or these markets have been trudging along, slowly going sideways, because this is like a big ocean tanker turning around in the middle of the ocean. It's not going to happen in a day. And so in this period where the market is going sideways, which is really what it's pretty much been doing, we've gone slightly higher in terms of the S&P 500, but not so much in terms of the small caps. So we've been kind of going sideways, and in that period of it going sideways, the people who don't watch charts, their opinion is formed entirely from the people cheerleading on the news, and so they think that everything is fine. But we chart watchers, we know. Wait a minute. In a year and a half, it should not have moved so little or just be going sideways. That's trouble. And so internally, that's companies rotating money, like I showed you here. That's whales, big investors, and rotating money from these things to these types of things. So that's what's going on. That's what makes the market move sideways. That's what that is. Okay. Let's see. The last one is this is another one of those. Let's see. This TZA was a small cap bear fund. TVIX is a large cap. It's a VIX. It's a volatility uh, play. Volatility. This fund goes up when the volatility increases. Let's just say when the S&P 500 falls. Functionally, that's what it is. Okay, when the S&P 500 falls, this volatility indicator goes up. Now, this one here, the volume is incredibly interesting. This is the main stock that people purchase when they're betting against the S&P 500, which is your retirement account. You keep that in mind, your retirement account. This big volume spike of the entire time that the S&P 500 was rising, you'll see here people started betting against it, against the market rising. But the biggest bet against the market is the one that just happened this past week. This volume bar, or I say this week and last week, maybe last week. Okay, this is pretty vigorous. This is pretty vigorous activity. So when I was saying that I was seeing the put call ratio, I think I mentioned in the other video, I was looking at bets against the S&P 500. I was looking at the options market to see what big money folks was really doing, and they were going in betting against the market. And now this ETF uh, moves off of those puts, so I could see the volume here. So people were coming into this particular fund, buying shares of TVIX, which is an ETF, which is another way to bet against the market. And the volume was tremendous. So let's look at it again over the long view for the duration of, let's say, that decade of the bull run, basically. This is a tremendous amount of optimism. This is real money coming into the market, betting against it. Okay. And now let's look at the chart itself, the price action itself. Okay. So you can see an imaginary trend line right here from this point in May. So we broke that. So now the question is, will we break this particular trend line? Of course, I think we will, but we'll see. If we do, all those computers that are running the market, and it's a tremendous amount of artificial intelligence leading a lot of these trades. It's not contrary to what people say. It's not Trump tweets, okay? Okay. We don't buy that over here. Not on this technical channel. We don't get down like that. It's not no daggone Trump tweets, okay? All right. It's artificial intelligence responding to volume changes like this and violations of the rule of trend, or breaking a trend line. So a price breaking a trend line of some sort, or a big volume spike of some sort. Those are two of just several ways that these artificial intelligence program computers are running the world markets. Okay, that's what's causing prices to move. Those computers don't know why. In the world of technical analysis, we don't care why somebody sold. We know that they sold. And if we see a lot of people selling, we go, well, I'm going to sell too, or I'm going to buy too. It's like if you're in a theater and everybody starts running for the exit door, you don't stand there and go, why everybody running? No, you get your butt outside and you figure it out later. You run the safety. You run because the herd is running. And then when you're safe, you go, well, what happened? Well, that is the same mindset in technical analysis. We don't know why people are running out of the S&P 500 like it's a movie theater on fire. We don't know why, and we don't care right now. We just want to get out, and we can make money by flipping, by betting against it. Later on, we can sit back with a beer and your favorite smoke, and we can wax about why it happened and all of that. But in the meantime, we want money off the situation. That's the mindset of a technical trader. How can I profit off of this? How can I make some money off of this? Okay. Warren Buffett, he said, this was years, maybe 10 or 15 years ago. He said, if I lost all my money and I started trading again right now, he said, I'll get rich all over again. He said, because I have an advantage you have an advantage when you're a small trader. And that is, he said, I can go into the market on any day and I can invest everything I have with the press of one button. And I can sell and I can exit with the press of one button. He said, but when you have billions of dollars, you can't do that. Because the amount of money traded in any particular thing, any stock in one day is, and when you're Warren Buffett, that's less money than what you have to invest. So you can't press the buy or sell button and move all of your shares at one time, because you are the market when you have that amount of money and you bet against yourself. You begin to establish the price when you want to buy. And you're doing vigorous buying, your vigorous activity of buying causes the price to go up. And conversely, your vigorous activity to sell causes the price to go down. So rich folks, whales, they have to buy in small increments over a long period of time. And they do things like go into the options market and buy an options contract where every contract represents 100 shares. So they'll buy a whole lot of options contract to try to or sell a lot of options contracts to be sneaky about what they're really trying to do, because they can't move all that mind like that. Okay. So, but you and I can. You and I can. So let's see, what do we got here? So yeah, TVIX. This is one I did earlier. I called it the Vegas play, and it looks like it can. It looks like it's happening. So this volume spike is ridiculous. You know, let me see what we got here in the chat. See if anybody's riding with me. Oh, what's happening? What's happening, our rainy woman? What's happening? What's happening, Monica Lamb? Monica Lamb. Wait a minute, Monica Lamb. Are you the one that's over on the Sonetta talking about uh different contracts and stuff? How to get money, setting up businesses over there? I think I've had am I right? I think I've had exchange with you over there. Yeah, you do good. Yeah, okay, yeah. I'm glad you made it over here. I'm glad over here. You do good work over there. Y'all check her out over there, over on the Sonetta, in Garfield and Dagger Squad, and she hangs out over there. And I cruise through there when they talking about money and business, you know. And I spread some of those videos around when I'm over here on this side of the world, where folks like to say negative things, or use pro-black as a slur. Y'all know that pisses me off. Y'all know I can't stand that. And so I'm always taking some of the good work that they do over there on that side to show that, yeah, we don't know. We don't just over there just argue about history all the time, but that is important. That is important. Okay. But, we also argue about making money, I mean, so we're very much in the pro-black world. We know that we are in capitalism and we have to survive it. So welcome, Monica Lamb. Oh, thank you, Raining Woman. Raining Woman, she trades gold, and she's in my Patreon. She's one of my Patreon supporters. Okay, Faber says, being a trader, I understand why you're a technical purist. But for a person looking to be a long-term investor, would fundamentals be better, or can you be an investor as a technical purist? Yes, you can be. Let me say this: the technicals are superior in all ways, in all time frames. Now, I'm going to say that, and of course, maybe some fundamental person would say it differently. And I say, take notes on who says what, and see how it plays out, and you will come to your own conclusion. So there's a myth that the technicals are only for short term. That is false. The technicals work for every time frame. On the very first video on my channel that I posted in January of 2018, I do a 100-year view, a century view. I call the slavery trade, okay, the emancipation trade. This a waveform that started back in the late 1800s, okay, and this is what we're in, and I apply technical analysis. And in fact, the quote unquote fathers of technical analysis, they made projections about the price levels we would reach, including the decline in 2007 and 8, and including this point where we are right now. And like I said earlier, I projected that, where we are, not just me, but just about every experienced market technician was able to predict the area where we are now in the S&P 500. I had the videos posted. I've done it on the Brain Trust. I've been on there for over a year. And so it's lots and lots of published work of me calling that. But it's not special. That's just like basic technical analysis. I don't think that makes me some guru. It just, it just puts me where I am, and a decent chart reader. I say decent because I'm still learning all kinds of techniques and stuff, and I'm sharing what I know, in my Patreon. So yes, Faber, you can definitely be a better long investor or trader with technical analysis. Now, let me be clear how I use technical analysis. I personally don't buy individual companies. So therefore, it doesn't matter to me about what the company made and their earnings report. I buy ETFs or whole industries. I trade the macroeconomics. I compare the dollar as it relates to gold and metals and energy and metals. And I'll invest in a whole, I'll either invest in the oil itself or oil companies or gold companies or steel or metal companies or companies that use a lot of energy and metals. But it would be a basket of companies. That's just my personal choice because I don't like the fact that you go to sleep at night and you wake up in the morning and find out that somebody from the company was stealing money, and so or there's a class action lawsuit, and so the stock tanked because of some malfeasance of one individual. I can't take that. Now that does not say that's my choice. Now you can invest your way, but you can apply technical analysis to a mutual fund, an ETF, or individual companies. Okay, so it works no matter what you want to invest in. It works in the futures market. I trade in the Forex market. It works in the Forex market. So no matter what the market is, technical analysis works. You know, it just works. Let's see what else we got. Brother Danubian, Caesar Z. Okay, Real Vinsanity. What's happening? All right. So yeah, that's the dealio with technicals. Anybody got any other questions before I shut it down? Anybody else? But so yeah, stay tuned to this channel. I'm going to do a video. I'm kind of gassing out now, and I don't know if I'll get to it tonight or tomorrow, but it'll definitely be this week. And I gotta attack gold because I mean I don't mean attack like I mean assess the chart, do a chart analysis of gold because there's some suspicious activity there. It's a myth that real estate's always safe or gold is always safe. That's a myth. And I'm going to put it on the line in this chart. And we're going to see, hey, I'll be right or wrong, but I'm going to be on the line. And you're going to see, check this in real time with that, one particular call. But I can't put everything out here on YouTube. I have to show some loyalty to my Patreons. Okay. But I primarily want to talk about this S&P because everyone's retirement account is assigned to that. And I have to take I can't be a capitalist when I'm talking about that, okay? I want to make money, but I got to give that part away for free, okay? So that part, I'm going to give you that for free. But, like I said in that bond video I did earlier, make an appointment this week with your financial advisor. Go to your bank. I think a lot of banks will offer some free information. Your employer, you talk to your plan administrator over your retirement account. The company that manages that for you, they will give you some free counseling. I know that because they're handling your money. They will do that. They have to. So this week, you should definitely call them up and ask them, if you are of the opinion that the stock market is falling, ask them, what's a safe place for you to invest if you think the stock market is falling, So let's see. Says Real Vinsanity says what I think will happen to the bond market during the downturn. I think the bond yield, you have to check the previous video that I did today. I think the interest rate is going to go higher. I think that bond yield is going to go higher. The government announced today, I guess they fielded queries, okay, from the investment community to see if they will have any interest in purchasing a 100 or 50-year, uber long-term bonds, okay? And a bond is a loan from you to in this case, the federal government, if we're talking treasury bonds, the state government, if we're talking municipal bonds, and a corporation, if we're talking corporate bonds. So it's a loan from you to them. And so I don't think it's a coincidence that the government would ask that question at this point in time, because the people that made a lot of money in that run up in the S&P 500, which is the largest bull market in the history of economies, okay, and market history of markets. Those people want to preserve that money, and the government offers guaranteed protection of your principal. They guarantee it. When you buy that, invest in the treasuries, the government guarantee your principal. The government will raise taxes on everybody in the country to make sure you get your money. So a lot of uber rich folk, they side up with the government and they want to loan the money. They want to loan their money to the government at this time, you know. And countries around the world, they also want to loan money to the United States government. Okay, because I mean, why wouldn't you want to loan your money to the largest economy with the let's just get real, with one of the baddest militaries, probably the baddest military. So America will either raise taxes on its citizens or go take somebody's stuff. Okay, let's just get real about it. That's what it is. Okay, so um, so yeah, so there is a huge market in the world to buy treasury bonds, and I say to also buy the U.S. dollar, and that demand for bonds and the U.S. dollar is going to turn the focus away from the stock market in large part. But there are a few places to invest, and that's what I talked about today. Some of those funds that I talked about, and there's more. There are some sectors of the economy in that staples sector I'm going to be breaking down in future videos. There are other places to invest your money, but we're talking about a few slither of places. It's most of the market is going to be red every day. It's going to be a couple of slices that's going to be green, and if you don't know, or nobody's teaching you how money moves in crisis, and there's a playbook for it. Okay, if nobody's telling you that, you'll be hodling, hold on for dear life. That's what they call it. You'll be holding on to your sexy tech stocks and thinking it'll come back. And no, this is not the time for that. Okay, big money doesn't play it that way. So I'm out of here. I want to thank y'all, and see y'all next time. Look out for the videos ahead about gold, and then a separate one about the dollar. I don't know which is going to come first, but they will be done before this weekend is out, because you got to kind of begin to get a handle on this, so you can have some context to put the news in for the news later in the week, when the conversation turns to the bonds. And it's quickly going to turn to that, and the strength in the dollar. And I believe we're going to see weakness in gold this week. And so we'll see, if I'm right. But I'm getting all this information exclusively from looking at the charts and how money is actually moving. Okay. So peace, y'all.